afternoon. Right, so this is a picture of our open pit mine at our Tarcoola project, so it's useful mental reference as we move forward. Quick overview, who we are and what we're doing. We are a pure play gold, pure play South Australian developer. The state of South Australia is very interesting within Australia. It is actually the state that hosts the largest gold resources in Australia. It speaks for about 25% of Australia's known gold resources, but only speaks for about 2.5% of production. And this is really a legacy of the history of very heavy investment in copper in the state. So South Australia is a major copper producer. In the central Gawler, Craton, where we are, this is where BHP has now consolidated the IOCG district. So they have Olympic Dam and they bought Au JORC Minerals. And now they have Carrapateena, Olympic Dam, and Prominent Hill. But that same mineralization, the same basin that hosts their IOCG province, as it trends to the west, it gets more shallow. And as it comes to surface, it becomes predominantly gold mineralization. And where it comes to surface, this is essentially a 130-year-old high-grade historical producing gold district, which has operated in a sort of small-scale intermittent production over that period of time. And it's something that we saw an opportunity to essentially consolidate the district and turn it into something much larger. So we did that. We acquired significantly every historical exploration and production asset of importance. We acquired the only gold mill in the region, and the strategy, rather than rushing it back into that same pattern of small-scale operations, was to step back, build up a much larger geological understanding around some of these key assets, understands what's feeding them, and then leverage the existing mill to turn on a staged series of developments, essentially self-funding from the first plant, and grow up to 150,000 ounces. The key there is looking into the future and being sure you can map that pathway to scale. So we have now done that. We started by mapping the large-scale asset first, and now we're building backwards. So we've got that large-scale asset going into studies, and we are now working on building up the short-term mineralization that we're going to use to leverage that plant. We have a track record of moving very quickly and cost-efficiently doing this, and we're still very well capitalized. So we've got about $8 million in cash, and we also have multiple sources of income. So we essentially subsidize a lot of our work internally. This has kept our capital structure very simple, very clean. We IPO'd 3 years ago with about 175 million shares. We have 220 now. We've placed almost entirely all of our capital inside of our existing registers. So we effectively have very little dilution. And we essentially have a track record of our share structure continuing to consolidate into our board, management, private equity, and family offices. Really, one, surrounding board and management alignment, but two, this is just really consistent, reliable, cost-efficient progress. So today we've got about a $60 million market capitalization, or about a 50 million Australian dollar enterprise value. And most important when we're thinking about our capital structure is our human capital. So we have some rather large ambitions, and we have built a team that reflects that. So our leadership team has well over 300 years in experience exploring for, permitting, financing, building, operating, and optimizing major mining assets, with a particularly strong pedigree in gold and South Australia. About half of our leadership team come from Normandy Mining, which was the largest gold producer in the Southern Hemisphere until it was sold to Newmont in 2002 as a 2.5 million ounce per annum producer. So why have we built this team? Well, we've got a team that integrates every major skill set required to achieve this objective. And the objective, in simple terms, is to build the assets as we know them today into a 150,000 ounce per annum producer. And we're really focused in looking at this at our Tarcoola and our Tunkillia assets, which you can see in the bottom right of the screen, those sort of orange blobs there. We are focused on open pit mining for the simple reason that open pit mining is easier, simpler, cheaper, safer to explore for, develop, and operate. You can get efficiencies of scale and defend against inflationary costs that you cannot in the underground environment. And these two assets together, they're neighboring assets, but they're really kind of one project when you think about it. There's about 3,000 square kilometers of ground. They're 70 kilometers apart from one another. So this is very large ground. These are essentially satellites one to the other. On this 3,000 square kilometers of ground, we have mapped out over 100 kilometers of major structure, and on less than 5% of that, we've now built up a 1.5 million ounce resource at our Tunkillia project. So again, the idea is establish as a strategy long-term baseload mineralization, and now we are moving our focus to complementary neighboring high-grade mineralization 1, that we can blend into that large-scale baseload over time and enhance those economics. But two, we also have a very interesting opportunity that we can leverage our existing mill, start a stage one operation, and then go from 0 to 150,000 ounces per annum in a staged, lower cost, lower risk model where our capital cost, or since the cost of crossing the drawbridge from explorer into operator is the cost of refurbishing an existing plant instead of the $200 to $300 million and 2 to 3 years required to permit and build a new one. So now we are looking at all of the different little ore sources that we have in and amongst our stage one area. We have fully permitted mines. We have a fully permitted, fully licensed mill. We do not need a lot of ounces. We just need to choose which ounces are the right ounces to start producing 20 or 25,000 ounces per annum. Do that for 2 or 3 years while we're permitting the development of Tunkillia, and then go from 20,000 ounces per annum up to 150,000 ounces per annum. And in doing so, we have made the transition from explorer developer into operator. We re-rate our equity, we re-rate our credit profile, importantly. We also changed the culture from developer into operator. That's very, very important. And we are then simply expanding an existing operator instead of trying to jump from 0 to hero, which is quite difficult to do and very risky, both technically, culturally, and financially. So the idea here is lower cost, lower risk, and therefore, of course, from the equity standpoint, much lower dilution. The strategy around bulk open pit is really led by the evidence that we see empirically, financially, that bulk open pit mining works better than everything, everywhere, all the time, including in the gold space. So we model our Tunkillia development after Capricorn Metals and their Karlawinda asset. And we were very fortunate when we were looking at the due diligence on our asset. We were looking at that in 2017, just when Karlawinda were sort of hitting their straps and growing their asset. This is an asset they acquired in 2015 as a 650,000 ounce asset. They grew it to 900,000 ounces and then 1.1 and 1.3 and 1.5 million ounces, and they focused on developing it as a bulk efficient open pit operation. They have since grown this to 2.25 million ounces at a grade of 0.7 gram per ton, which people would conventionally look at and say, well, that's low grade. Today, that is one of the lowest cost gold producers in Australia. They are processing 4.5 to 5 million ton per annum mixed fresh and oxide material, and their all-in sustaining cost for fiscal year 24, which in Australia is the year ended 30 June, was 1,400 Australian dollars per ounce, well under 1,000 US. This is a globally competitive approach, and this team, this is the third time they have done this in Australia. So this is really a very proven model globally. It's also a proven model in Australia, and it really comes down to the geometry of their resource. That's something that we really liked in our Tunkillia asset. We acquired Tunkillia at the beginning of 2020. It's a 550,000 ounce asset. We grew it to 900,000 ounces. We found 5 new gold zones, and then we grew it to 1.1 and 1.3 and 1.5 million ounces. And now we've published a study demonstrating that's a very attractive producer at 5 million ton per annum. So the footprint that we're looking here with Tunkillia, what we can see is a collection of resources in a very straight line, so to speak. This is the western margin of a kilometers wide shear zone. This is sort of a Kalgoorlie shear system style setup. And the key takeaway here is that this is an asset that was just underexplored, underallocated capital, misunderstood, and we have demonstrated that the endowment is considerably larger than it was historically understood to be. We've done 4 resource upgrades. We've done very efficient growth. We've now published a study, and we've taken a very conservative approach to the modeling of the resource, but also the modeling of that study. So we think we have a lot of upside left in the optimization, which we're currently going through, before we take it into full feasibility. But we also have a lot of upside in this geology. We have over 20 kilometers of untested shear along strike. And when we look at the deposit, thinking about why were we attracted to this and what makes this tick as a bulk open pit operation, it really comes down to the geometry of the geology. Mining is the practice of blasting and lifting and moving and processing rock. You are trading energy for metal. And the more efficiently you can do that, the more profitable you can be. So we like the premise that volumetric efficiencies will drive in capital and operating costs. And what we're looking at here is a body of mineralization that in the middle in particular is very broad. So this is 80 to 100 meters thick. This is a football field long, wide, very broad, very bulk open pit mining. And within this deposit, one of the first things we proved when we drill tested it is that there's actually a 300-meter long higher grade zone in the middle. So 10 to 30 meters of that 80 to 100 meters actually grades between 2 and 10 gram per ton. So this is a very ideal starting pit location. And then we also have about 250,000 ounces in this supergene T zone that you see in the cross section. So as we do our initial pre-operating strip and also our operating pre-strip, we're getting cheap, easy gold paying us to do this pre-strip. And this shifts forward a lot of the cash flow and economics in this operation. So again, the idea here is how do we test the premise that this works at scale? Well, what we did was we said we are going to fix our processing volume at 5 million ton per annum. We're going to solve for CapEx, OpEx, and mine design, right? So we want to validate the premise that this works efficiently at scale. Once we figure out how that equation balances, then we'll go through and optimize things. And the way this came out was pretty attractive. So what this gave us was using about 60% of our resource. It gave us 6 years of operations at 130,000 ounces per annum at an all-in sustaining cost of just over $1,900 Australian per ounce, which is about $1,250 US per ounce. Now, that also drives an equity IRR of about 40% and a payback of 1.9 years, which goes back to the geometry that we were looking at there. But key to understand here is we threw some very unfavorable assumptions at this asset when we looked at testing it. We assumed that our power costs were higher than we expect them to be. We assumed the material was much harder than we expected it to be. We assumed that we only crushed it at a single stage and we're putting 150 millimeter bowling balls in a giant oversized SAG mill, and it still gave us this efficiency. So we tested this like we are continuing to invest in our own asset, which we are as the largest investors, and it's passed the first test. So now we are optimizing it. We're pulling back the hardness, we're pulling back the power consumption, the mill design, making it all more efficient and running it how we now know it would actually run based upon the metallurgical test work we have. We will take some of these savings, we will push them into the mine design, smooth out the base of the pit, and spread this out into something that looks more like a conventional 8 to 10 year, 110 to 120,000 ounce per annum operation. One of the key things to take away when we think about this asset, if you look at the 2 columns of data there, why were we attracted to bulk open pit? Well, if you look at the life of mine metrics, again, this is a 0.9 head grade, again, similar to what Capricorn running 130,000 ounces per annum at around 1875 Australian per ounce. But that first year we have that higher grade zone, the first 5 million ton that go through that mill is running at a head grade of about 1.26. And that essentially increases the denominator to the point where we have 180,000 ounces at a cost of 1,200 Australian dollars per ounce cash cost. So the first 12 to 15 months of this operation, we're generating $400 million in gross free cash. That seriously de-risks the development of this asset from a financier's standpoint. So again, there's a lot of things that we're looking at pulling back here and optimizing these costs. And what we're looking at here is just in the green box. This shear zone has a lot left to give. We think this will turn into a field of bulk open pits. And if you have a series of these nearby, what you'd love to have is some high-grade gold. And that's where we, again, go 70 kilometers north to our Tarcoola project. This is actually where high-grade gold was discovered in South Australia. There is a 15-kilometer-long zone of high-grade historical workings that no one ever modeled the subsurface architecture in 130 years. Why is it interesting? Well, the pit that's there on the mining lease that's there, that little void is only about 60 meters deep at its deepest point, 30 meters deep at its shallowest point, 400 meters long, and somewhere around 50 to 75,000 ounces between historical high-grade underground mining and that bulk open pit came out of that hole at around 20 to 25 grams per ton. So there's very intensive mineral wealth at and near surface with this type of geology in this gold field. Now, we don't expect this to be 250,000 ounces. We're going to put 30 to 50,000 ounces on this pit to cornerstone this stage 1 operation. But when you zoom out and see what's going on around it, we spent 2.5 years building a new regional structural model, bringing all sorts of new tech in, doing deep and shallow seismic. And what it's given us is a map that shows us for the first time in 130 years, every single known historical gold occurrence in a consistent structural framework, which becomes a targeting map. And we've already made we've confirmed 2 high-grade occurrences already within that field. Perseverance mine, fully permitted, can go to our existing mill, and things like that as we advance into resource can head south, blend into Tunkillia when it's in operation, and give us more of these very attractive starter pit year one style returns. So for us, we're an extraordinarily busy business. The next 6 to 9 months for us is crystallizing our stage 2 platform and demonstrating that that is a very robust PFSable asset, and then now crystallizing the feed that's going to go into stage 1 and putting that on development track, leveraging that mill. So thank you very much.